Welcome to the Co-Living with PadSplit podcast, where we talk to successful PadSplit investors and have them share their secrets to success, not only in PadSplit, but in other facets of real estate. This podcast will help you expedite your learning to be a successful investor in the co-living space. We are your hosts, RayandOrianna Nunez. Show us some love by subscribing and sharing so we can continue to bring on amazing guests. Wow, guys. This episode is crazy. We spent an hour and a half going into detail about financing PadSplits. Fernando is sharing some amazing insight on how to do it, things that he's actually done for his clients, challenges that he's faced through financing, the evolution that he's seen with financing in PadSplit. You can't miss this episode. I feel like I say this on every single one of our episodes because they have so much value, but financing is one of those sections in the process of becoming a PadSplit host that most of us find a lot of hurdles in. So the amount of value that we're adding to you in this episode, wow, we're giving away so much value. We want to do this. So do not miss this episode. Fernando, how do they stay tuned into this one?
How do they stay tuned?
Yeah, they can't step away from this one.
So this is the one where when I meet with my clients, and we're closing 30, 40, 50 PadSplit loans in a few months, the information that I really just have one-on-one with all those clients is being released in this episode. So I'm excited for everybody to hear.
Yeah.
Get it free before he starts charging people for this extra. So stay tuned to the episode. We look forward to dropping some knowledge on you, and make sure to like, subscribe, and share. Thank you so much. Enjoy the episode.
Thank you guys.
See you guys.
And let's talk what you're freaking good at, what you've been focusing for the last year, and you are eating, breathing, sleeping.
Yeah.
Which is financing.
Cool. Let's do it.
How do we get started? If I'm a brand new investor, I have never done a PadSplit before.
Right. Yeah. There's different ways
And there's really so many ways to kind of start into acquiring a PadSplit.
Yeah.
It could be starting conventional.
That's good. So, I think the best way to start right now is to give a couple of stories of investors.
Yeah.
We can actually bring you guys into this too.
Yeah.
Yeah.
So obviously we're all three of us are investors
Yeah.
in PadSplit.
Yep.
So the first one I bought with a conventional loan. And so why would somebody want to buy with a conventional loan? Well, if you have good income, and you don't, we'll get into the cons, but let's say you just have good income and you're like, I want to make sure I can go 15% down.
Right.
Which you can do. You can go 15% down on a purchase. So where does that help you? 5% of 300,000 is 15 grand.
Mm-hmm.
So you're trying to reduce your cash out of pocket on your initial purchase, save that 15 grand to rehab, go 15% down conventional.
Correct.
Right. So that's just one scenario.
Also better interest rates in comparison to potentially hard money.
Sure. Yes. Pros and cons, because if you go 15% down, you can get higher interest rates because the bank's taking a higher risk. So in that case, we're talking, July, we're in July 2024.
Yeah.
You go 15% down, you're going to be paying points for the rate, and you're going to be in like the 8s.
Yeah.
Right. But now you have, if your purchase price is high, it makes sense, to save yourself that 5%. So you go conventional. Now, con, you can only have 10 conventional loans in your name.
It will limit you.
When you think of scaling, if you're just watching this for, you're just getting into it and you're like, oh, I don't have any. Perfect. Then that may be the good route. Okay. Other con, you now have to pay for the rehab out of your own pocket.
Correct.
So you buy a house for 300 grand, you put 15 into it, right? So you're at $45,000 down payment.
Mm-hmm.
Now you've got closing costs. Closing costs could be another 10 to 15 grand on a conventional loan.
Yeah.
DSCR closing cost is more expensive, right? So DSCR loans we'll get into later. That's it can be more expensive on the fees. Okay, but let's talk conventional still. So now on a $300,000 house, you went 15% down, or 20, right? You got to look in where it makes sense.
2 options. Yeah. Or where you qualify.
Where you qualify.
Yeah.
Right. So we'll just say you go 15% down, $300,000 house, that's 45 grand. And then you're going to have to pay another 15 grand in closing costs. Now you're at 60 grand all in. You just acquired your property.
Correct.
But that's not conversion. That's
you
not
have not added one bedroom.
Additional, right? So
no
that's
furnishing, nothing.
Let's say that's a 4.2.
or 4.3. I mean, in a perfect world, it's a 4.3, but maybe more 4.2. Is that fair?
Yeah.
So right now, when I estimate my rehabs, I'm like estimating 5,000 a room. That's not just for the walls. That's including if I need to replace the air conditioning to pump into the different rooms, if I need to furnish, if I need to do electrical, and do the ducts. What do you guys estimate when you're estimating at adding an additional room to your property?
5 to 7 is a good solid number that we have averaged, including even furnishing.
And we factor that in. Well, we burr, so it's a little different because we factor that into the upfront initial rehab cost.
But that's a good average.
Yep.
Right. So we're just talking conventional here.
Yep.
But let's talk burr later. So if you're just buying, again, as an example, 300,000, 15% down, you're at 45,000 plus 15,000 in closing costs. You're at 60,000, and that's a 4.2. Are we turning a 4.2 into a
6.2?
A 6.2?
Living room, dining room.
Me and Fernando are at 8 bedrooms right now.
I do have 2 8.2s and 2 9.3s.
Okay, so no, let's make it an 8.
No. Let's talk about what I would do, knowing what I know today.
Okay.
Would I turn a 4.2 into an 8.2? I would turn a 4.2. I would first of all scope the property out.
Of course.
Is there a way that I can on the other side of the bathroom? Can I add another bathroom?
Plumbing.
Right.
Is it easy for me to add another bathroom?
Exactly. If there's a bathroom right here and I can add another bathroom just right beside it, connect the plumbing there, then it makes it a lot easier. And then now this bathroom that used to serve another 4 room or whatever, I can now make that a suite. And then I open up this other bathroom over here to serve other rooms. So in my head, if you are going to go 6 beds, then I'm going to go like 6 bed, 3 bath, right? Or I'm going to try to get another bathroom in there so that at least one of those rooms can be a suite. So now let's
do a 7.3 then.
7.3, to be honest, that makes me feel really safe. If I'm making a 7.3, I'm making good money.
Yep.
Yeah, let's do a 7.3. 7 is the lucky number. I like that ratio.
Yes. Now, I did tell you about a client of mine who's doing 6.4s. Also really good though.
2 en-suites?
2 en-suites.
2
and 2
baths.
public.
Yes.
So 2 to 1.
Exactly.
Nice.
Now you got like a Jack and Jill setups and everything, right? So 6 bed, 4 bath, but that was a ground up construction game. Super strong, like super clutch, because you're going to charge a lot more for the Jack and Jills, which is just a 2 bedroom, 1 bath. And of course the 1 bedroom, 1 bath, that's your big money maker. For me, I have a 1 bedroom, 1 bath that I charge between $240 and $280 a week.
In Atlanta.
Yeah, in Atlanta. Whereas my 4 bedroom, 1 bath setups, and I know we're speaking pretty quickly. I don't know if this is for the beginner PadSplit person, but hopefully they re-listen to this.
100%.
No.
The 4 bedroom, 1 bath setups, I'm probably between 145 to
175.
Okay. To 175.
Okay.
Fair enough.
Okay.
Is that kind of what you guys are seeing?
Atlanta, yes. Orlando, it's a little higher.
There you go.
I will say, and I'll say this for the audience, if it's a Jack and Jill bathroom over a regular room with no bathroom attachments, the price difference between the two will be about $30 extra a week. From a regular room with no private bath to a private bath, private ensuite, you're looking at $50 to $70 premium for that particular room.
Yeah.
So a 6.4 is fantastic because you have 2 rooms now at a premium. So if it was $200 a week, now you might be looking at $270 at best.
Yep.
For those 2 rooms, that's $140 extra a week.
Yeah.
That you're generating. So it already sets you off in a way better place.
Totally.
But keep going on.
So we went down the conventional road.
We're at 7.3, so we're saying $5,000 per bedroom. So now we're 15 more. So 60. Now we're at 75.
Right. So $75,000 out of pocket. When my wife and I first bought our PadSplit, we only had $65,000 to my wife's name.
Yeah.
I was broke.
Yeah.
And we used her conventional income. She was a teacher and she had a steady job and everything. And she had income that we can buy this property. She had the cash that she had saved for 5 years. So like $75,000 is a lot of money.
It is.
Yep.
And it takes, I remember after we bought the first one, I was like, shoot. I was going to say the F word, but I didn't say it. So I was like, shoot. We have to wait another 5 years before we can buy another
For
one?
us to do this again.
Like, that sucked. Okay, well, spoiler alert.
We ended up buying 3 in the next 2 years and we can get into that too.
How did you do it?
Yes. So option 1, conventional,
Yes.
buying conventional. Why did we do it? We were afraid of rehab. None of us had any experience using a hammer or a drill or talking to contractors, but we wanted to get in the game. And so for us, that was our lowest barrier to entry.
And it also felt like it was a more traditional route to take.
Totally.
More
Totally.
secure.
And we're happy with it. Like I said, 15% down. The rate we got at that time was 3.5%. It was an investment property.
You can't beat that.
Like, yeah, why not? And I just realized.
No, that's great. That's great. That's great.
Yeah.
A little closer.
That's great.
Whisper. Okay. Second property we bought.
By the way, something that I also want to add to that conventional route, it shortens your time to revenue.
100%.
So you already put 70 grand in. Now it takes you, call it 2 months to get to start cash flowing from renting those rooms, since it took you 30 to 45 days to get to closing and a month and a half to get it all set up and ready to go.
Right.
So you're
True.
shortening that time to revenue.
True.
To start getting back some of that money into your pocket.
Right. Because it's going to take you maybe a month to do the additional rehab.
Correct.
Right.
And then setting it up, furnishing, locks, ready to go.
Maybe a month and a half, 2 months, right? And you get it listed and everything.
Because like house can't be jacked up if you're using conventional financing.
Can't.
Oh, it's in great condition. It's a turnkey
Right.
home. It's a turnkey
Conventional
property.
home. If it has a hole in the floor, a hole in the roof, it's got boarded windows,
It's
broken
not
windows.
gonna pass.
It's not going to close. You're going to have to fix the property up before we even close on it. Okay, so going conventional. The second property we bought, and this one is, our intentions. I'm going to put it like this, to be politically correct if this gets released into the federal government. So we, our intentions were to buy it as a vacation home, because my wife and I have dreamt of vacationing in Atlanta, Georgia.
So have we.
And so
Not in Atlanta.
we used a 10% down vacation home loan that you can use one in every state pretty much. So,
What is this loan called?
it's a second home loan.
Okay.
And
It's an investment property loan, right? Like second home. Like, is this part of the 10 that you can acquire?
so,
Is it a second primary?
yes.
Okay. Sorry. Confused.
No worries. Good point. So this is where I go back to my intentions. So if an investor comes to me and says, Fernando, I want to use a 10% down vacation home loan, and then I say, well, your intentions are for you to live in it 2 weeks out of the year. True.
Yeah.
Yes. Good. It's good enough for me if I understand what your intentions are.
Yeah.
Now, realistically, after you close, whatever you do with property is beyond my control.
100%.
Like you came to me and said, Fernando, like my intentions are to treat this property as a vacation home loan. I'm going to live in it for 2 weeks out of the year. Totally legal.
Yep.
Let's close.
Yep.
Let's do a deal. So that's how my wife and I bought our second property, 10% down. And going back, and at that point, though, we still needed the rehab money
Right.
because it's still a conventional loan. It was a good house. And this was the first time we got a little down and dirty. And
Originally, how many rooms?
that one was also 4-2.
Okay.
Because we thought the first one's going really well. Let's get a second one.
Yeah.
And the second one we bought, it was a 4-2 still, but this is our first time making a mistake, and we didn't inspect the sewer from the house to the street. And so then our contractor goes in after we buy the property and is like, hey man, like you got a broken pipe like from here to here, and you gotta rip all this out. And if anybody knows anything about construction, which we didn't know at the time, that was a $15,000 job.
Ouch.
And so that extra money that we had saved by going 10% down, thinking we were smart,
That 10% became
10% became way
something
bigger
else.
than the first property we bought. And so we had to do like a pretty, what I call the biggest rehab I've ever done in my life. $15,000 to
Yeah.
repair the plumbing between your house and the street, which you're responsible for as the owner, right? The
I was
city's
going to ask you if the city.
same
city's not
question.
responsible for that.
Wow.
So
I bet you called though first.
we
That's a logical thing to do. You call the city, hey, do you guys cover this? No.
No, well, actually, I didn't call the city. The you know,
Contractor told you.
everybody told us, they're just like, yeah, man, you got to
No
cover
way.
this.
It's up to you. Mm-hmm.
So we're like, all right, you know, just bite the bullet. But at this point, though, we'd used a combination of our money and then my wife's parents' HELOC. So that's how we were able to then fund the deal.
Mm-hmm.
And so that's how we got our second property, right? Conventional loan. Still conventional, using my wife's income, different loan product, right? First one is a conventional investment loan. This one was a, you know, second home loan. And the third and fourth home, similar to how we bought, was using hard money. Sorry, did you want a question really quick?
No.
Okay. And first two were 8-bedroom, 2 baths. And I was like, man, well, what if we had another bathroom? Could we make more money? And then like we had a handy dandy Google spreadsheet, and we said, add another bath. You know what I mean? Like we had a little button that you could just next to the bedrooms, you just add another bath. And that increased our cash flow. You know, when we added another bath by like, you already know, was it $300, let's say, or more? Like,
yeah, it was like $50. It's like $50 a week. So 200 could be like 250 more.
But at that time, because remember this was a few years ago, the 1-bedroom, 1-bath type of setup was super unique.
Mm-hmm.
People hadn't really been doing it. So in Atlanta, this was like, I know for sure we were making $285 a week on that one, which is crazy. I was
that
like,
is crazy.
This is wild. Now it did drop a little bit more, but so overall, those 9.3s is how we were able to keep up with the high interest rates. The first two we got at like 3.5% and 5%. These next two we got at 8% interest, but we're still making $2,000 to $3,000 a month, right? So we learned like, okay, well, let's add another bath. Let's create that ensuite. So we have 4-bedroom, 1-bath setup, 4-bedroom, 1-bath setup, and a 1-bedroom, 1-bath setup. And so with those, we first got in using hard money.
Yep.
We rehabbed the property, and then we refinanced
into
a DSCR loan, right?
Debt service cover ratio.
Yep. Debt service coverage ratio. So the benefit of buying hard money was, for me at the time, did you have a question really quick?
No.
I just got to share that. And I posted this on the Facebook PadSplit group. But basically, I had just started trying to raise capital because I wanted to scale to 10 PadSplits. Mm-hmm. And this was when rates hadn't started going up yet. And I started just like reaching out to a bunch of people, pitching PadSplit, partnership, collaboration. I had started to build the confidence that like, all right, I think I'm a real estate investor now. Like I'm going to go out there and like try to raise some capital. And I joined the right people. Like, let's go do it. So I just started reaching out to people, like other people, random people, my friends. And then I got this, I spoke at a meetup in California, and this mom, she came up to me afterwards and was like, hey, Fernando, like we have this HELOC money as well. Never met her in my life. She had her 2 daughters, and she's like, I think we want to invest with you. Like we really think this is a cool model. And I was like, dope. I was like, this is sick. So so for anybody looking to raise private money, you just got to put yourself out there in positions to speak and let people hear your story and what you're trying to accomplish. And then, you know, the stuff will figure it out from there. But then this is the reality of what happened. We got her husband involved, and he was cool with it in the beginning. And so I had sent the earnest money deposit for buying this property. And I told
an acquisition in Atlanta as well.
An acquisition in Atlanta. And my wife was like, hey babe, like, you know, because we still didn't have like a lot of money, and like $5,000 was a lot of money for us too.
For sure.
Because they were going to fund the whole project. I was just really excited. And I was like, no. They gave me their word. Like, it's all good. I'll send the $5,000. And so of our money. And my wife's like, I don't know if you should have done that. Like, you should have had them put skin in the game. And this was before I used to listen to my wife. Now I listen to her. And then next thing you know, 5 days before closing, it's a hard money stuff. So you already know you lose your earnest money because there's no due diligence period.
Nothing.
They pull out. They call me, and there's a whole charade, and they pull out, and I'm like, dang, you know, we're in the car.
Crap.
My wife's driving, and she hears me having the conversation in the back. We have our daughter right next to me too, and I'm just like, my heart drops. I'm just like, dang. And they're like, you know, they're pulling out. And then my wife could hear me, and I'm just like, I feel defeated, and I hang up the phone. I'm like, I think we're gonna lose our $5,000. And then remember we talked about the emotional, how quickly can you come back? Probably 30 minutes later, I'm like, I'm not out yet.
Yeah.
I'm not out yet.
We still got time.
We still got this. So then that day,
We can figure it out.
yeah, I put out feelers, and I sent it out to my Instagram. I had been posting on Instagram for 6 months at this time, just like sharing my journey. And I got this other lady, this lady that she's a young lady, but she reached out and said, Fernando, like, I've been following for 6 months. She's like, I'd like to partner with you. And I was like, sick. So literally that Friday, she wired in tens of thousands of dollars in the title. We closed, so I didn't lose my earnest money, and I got reimbursed by $5,000. And that's how we got our third property. So it was pretty wild. So that was using a hard money loan. Yeah, you guys already know.
Question for you. Today, knowing what you know, which of the different ways of buying properties would you buy?
Yeah.
Oh yeah, hard money for sure, right? Like once you don't have the fear of it, then it becomes a tool. And the thing,
leveraging tool for sure.
Leveraging tool. I mean, you guys did it, right? And one of your properties, I think if you can share numbers, but you told me you instead of leaving all the money in the deal, like I still left money in the deal, so it's not like you're doing a perfect refi and getting all of your money out, but you're still leaving money in the deal. But what if you're only leaving 5% or 10%?
Yep.
I mean, even if you're only leaving 15%, it could still be a good deal. Your cash on cash return is going to be great. So for me, I would just always be buying with hard money, rehabbing the property, and then refinancing out, knowing what I know now, for sure.
Okay.
That's kind of what unless there's an already converted PadSplit that I can just buy with the straight up DSCR loan that doesn't need that much rehab, then I would consider that too.
Okay.
What has been your experience with financing some of those types of properties that are already converted PadSplit homes? Like, what makes them appealing, and are they financeable? Some of the questions we get as
all the time,
account executives,
like, how am I going to finance this?
Yeah.
Is there magic involved in this?
There is magic.
So there's definitely some magic, and I'm going to give a shout out plug to Jeff Wheeler. He's been like a mentor to me, and him and I have been able to collaborate.
Shout out to Jeff.
That's my boy, Jeff.
We've been able to collaborate on different loan products and approaching different lenders, where literally we do research and development. And the research and development we do is I have past appraisals that have funded that are PadSplits, that are 10-bedroom, 4 baths. And I start sending them out to all these different lenders that we have access to. And I'm like, hey, would you guys lend on this? Like, would you lend on this? Like, literally it's these conversations, and then you have to go down that rabbit hole, and you have to teach them about PadSplit. Before we used to hide a little bit of what a PadSplit was. We didn't want to disclose a lot of that information. At scale meaning like when you're closing 10, 20, or 30 loans,
Right.
it gets taxing, and you don't want to like play that game anymore. You're just like, look, I just want to get people that understand the model. They're for it. Kind of like when Airbnb first came.
That's right.
And like people were afraid of it, and then all of a sudden like Airbnb products started to come. So that's the era we're in right now. PadSplit products are starting to be created, like legitimate PadSplit products. We don't have to hide.
This is so beautiful. It's a beautiful progression to
Good
see
time
us
to be a
going
host.
to see us going from having those challenges to now having conversations that are inclusive and progressive towards a solution.
Yeah.
It's a different environment.
We literally will write in our loan submissions now, like, this is a PadSplit property. And the lender's like, cool.
Good for you.
Yeah, let's run it. There are additional like hoops.
Right.
So it's not
For
going to
sure.
be, I mean, your closings right now are probably running more like 30 to 45 days.
Okay.
So this is us like buying converted occupied PadSplits, right? So we're not closing in your like normal 20 to 30 day cycle right now, because there's learning curves and the lenders building their guidelines.
They're also doing a lot of them on their end to search
Yes, exactly.
and adjust to this new model.
Exactly. Right. Because they have to protect their risk too. And then who are they selling those loans to? They got to be aware of that too. So, yeah. Where do you want me to go from there? Because I can take that a few different ways. We can take it through like the type of house to build to make sure you get that financing, the terms. We can get into
Let's
the
talk.
terms
Let's
and
talk
the
about
rates.
that. Let's talk about the houses.
Yeah, let's talk about the like how to set it up correctly in order for this to
Yeah.
be a smoother process
Could
on
I-
the financing.
Good one.
Could I have closets in every room? Is
So
that something?
so right now, I'm going to be purchasing, helping a client purchase 2 10-bedroom, 10-closet pad splits.
Whoa.
Huge.
Okay. And then here's the cost to that. Cost is they're going to be going 30% down,
Mm-hmm.
and their interest rate may be 8 to 8.5%. Right. But
Okay.
the biggest hit there is the 30% down that I can't
Overcome it.
that's a big chunk of change, 30% down. Now we have another lender where we can go 25% down, but now your interest rate's like 9.5 to 10.5%. Right. So there's always going to be a cost. So if you don't buy that, that brutal of a property because of the closets, let's say we wanted to buy an 8-bed, 2-bath, or even a 9-bed, 3-bath, or even a, like we talked about, 7-bed, 3-bath, right?
Mm-hmm.
The additional rooms that are added, we talked about taking a 4-bedroom. We talked about taking a 4-bedroom,
A 4-2,
2-bath into a 7-bedroom,
3,
Bath.
a
3-bath,
7-3.
right? So number one, permit the bathroom.
Mm-hmm.
If the zoning in your area requires permitting,
Mm-hmm.
because that's how you can actually elevate the value of the house.
Right.
It's only in your benefit. But
Right.
in parts of Atlanta, if you add a bathroom, bless you.
Bless you.
If you add a bathroom in the downstairs area, like the basement or the bottom level, you don't need to permit it, because even if you did permit it, it doesn't add the value, because the city doesn't count the bottom square footage as additional square
Interesting.
footage. So then it's a way for us to finance deals in Atlanta as well. So you can have literally a 4-2 upstairs and like another 4 bedrooms, another bathroom downstairs. And we don't care about the bottom one because it's not even counted as square footage in the value anyways.
Interesting.
So then that's how, we do these deals too. But going back into, if you're building it from, as from a 4.2 to a 7.3,
Yep.
check if you're zoning, if you need to permit that bathroom, check if it's adding square footage. And then the additional rooms that are added. So from a 4 to a 7, you're adding 3 more rooms. In those rooms, do not add closets.
Can you elaborate why?
So the way that we've been able to talk to lenders and appraisers, because we also talking to appraisers, we're also saying, count the rooms, like the way that we push back, count the rooms that are legally defined as bedrooms. And
Which
to
means
be,
a closet.
right. So to be legally defined as a bedroom, you got to have 2 modes of egress, a window and a door, right? So if it doesn't have a window, then it can't be counted as a bedroom either. But then if you don't have a window in one of your rooms, like it's an asylum. Just kidding.
And a minimum amount of square footage. Also.
And it's got to have a minimum amount of square footage. And I know PadSplit, what's the minimum square footage right now
80.
with PadSplit?
It's 80.
8 by 10.
But it's funny because in some cities they say that, and not PadSplit, some cities consider a room 70 square feet. But PadSplit having obviously a better standard than just the minimum, we say
Right.
80.
8 by 10.
And just on that, I'd probably make it even a little bit bigger too, because what I'm seeing is my small rooms that used to rent well,
Yep.
no longer rent as well anymore. So I'm like, shoot, I shot myself in the foot.
Equally to us. We have 3 small,
Yeah.
like next to each other. We maximize 3 instead of 2, and then those remain
Yeah. Not
vacant
as
a
booked
lot
as
more often. Yeah.
Or somebody moves in and they're like, oh, this room's
too
a lot
small.
smaller. Then I'm like, oh, shoot. So, learning lessons. So don't, just because you can do it super small doesn't mean to do it super small.
It doesn't mean it's
sure.
better neither. Yeah.
It's called the
Right.
minimum for a reason. You're going to get back the minimum too.
Yeah. Yeah. And exactly. So I would not aim for the minimum.
I want to weirdly ask.
Yeah.
I'm not going to ask you what's the best market, but where are investors flocking according to the loans that you're doing? And then what are some of the trends?
Yeah.
So if you're doing like,
I feel like because of what he's currently managing, it's going to be a very one
So-
specific answer.
No. So,
No,
You know?
so let's,
could-
so let's talk about it though. Right.
Yeah.
I mean, we're doing loans, Tampa, Jacksonville, right? Atlanta, Raleigh, Charlotte, Houston, Dallas, Phoenix. So every market you guys are in, like there's a need.
Mhm.
And I do ask the investors, hey man, like, how are you going to be making money?
how much money are you making? Everybody's making at least $1,000 a month.
Mm-hmm.
So independent of the market. And the person who's investing in Phoenix or Dallas, I'm like, well, why don't you invest anywhere else? And every investor is going to have their own reasons.
Yep.
And like, man, like, I mean, I know Phoenix, or like, I want the appreciation play as well. I know the markets. I know who I can hit. Whatever it is, right? Like, they have the team.
Right.
Because the team's important.
Oh,
Yep.
yeah.
If you don't have a trusted team, and I know investors that are maybe, they're like, Kansas City. That's another one,
Oh,
right?
yeah.
Yep.
KCMO. That one's like spinning up super well right now, and there's a lot of demand over there. So I'm excited to see how that market does too. I personally am not like, I can't go to every single market and invest my own money in every single market, but I can at least hear how everybody else is investing. So I don't want to knock a market at all.
No, not at all.
Because I don't have personally like enough data everywhere else, but I know other investors are doing it. So if like other investors are doing it, my suggestion is find those investors, and you can hit me up, and I'm happy to, if the investor is open to meeting with the person, I'll make an introduction. So if somebody that's interested in Dallas, I'm happy to make an introduction to one of my clients who's investing in Dallas, right? And just so you can see how are they making money that way.
Right.
Or I'm sure if somebody reached out to you guys, if you have a host in Orlando that's making money,
For
if
sure.
if the host was cool with it, making, speaking to them, I'm sure you guys would make the introduction.
Always.
So that's all I can say on that. That everybody I know is making $1,000 or more
Minimum.
Exactly.
Wow.
You're
That's really good. Like, just going back to it, I would assume that your answer was going to be Atlanta,
Yeah.
just because it's our most developed market.
Yeah, and I
Right?
wasn't asking best market neither. I was more asking like, where do you see most of your transactions being at in regards to like city wise?
Oh, got it.
And not in correlation that it's the best market, but it's just that where you see the most activity.
Gotcha.
And maybe assumption would be Atlanta because there's the most amount of.
But
hosts.
that's why I was like, I sense that, because also so many transactions that are currently happening in Atlanta that would have been, more driven.
Right.
But you see activity almost in every city that we're in.
Yeah. I think that's going to be, you got a market of supply and demand. So Atlanta, you said, is like 5,000 rooms,
Yes.
Yep.
right?
5,000 plus units.
Versus Orlando, you said was 500.
Like 600, yeah.
So two schools of thought. One person's going to say, oh man, yeah, like 5,000, there's a lot of activity. Cool. Another person's going to be like, look at the blue ocean. The blue ocean in Orlando. Imagine if now I create the supply in Orlando,
Yep.
and then now you can feed, the demand that's eventually, going to catch up, because we talked about it, where PadSplit's only going to continue to grow. It's so new. Like, it's still so new.
It's so
If
new.
anybody's listening to this right now, like, you're
It's
still
so new.
early.
You're still early.
We
Still talk to people that are like, I've never heard of it.
Yeah.
We still get that reaction, which I love.
Yep.
And of time of recording, we're not in California. I'm very sure by time of release, we'd have a few places in California, maybe a few places in other.
Well, we actively have one property, not in our personal portfolio, but
Oakland?
the platform has an existent property performing in California, which is Oakland, California.
That's dope.
Fully booked in a week, apparently.
That's awesome.
The need is there.
The demand.
That's super cool. I will say this, right? Because we're talking about the type of PadSplits to get financing on.
Yeah.
So we talked about the closets. And now instead of a closet, you can add a wardrobe, an armoire, exactly. So when it comes to the financing, people are like, well, do I have to remove the PIN codes on the locks?
The
do I
locks.
have to remove the numbers from the doors?
Yes, good one.
On a existing purchase of a
Or a
PadSplit
refi.
property?
Yeah.
Or a refi.
Or a refi.
Okay.
Yeah. Either scenario. Just overall, in general. Hey, Fernando, like, do I have to remove the door locks because they've got PIN codes and I've got numbers on the doors, right? And yes, a year ago, I would say
Certainly.
yes, we do have to do that. And like, if you've got a living room that's a room and it's got a door, like, let's take the door off the hinges too, and don't put the furniture in. There's all that stuff today, right? We don't have to worry about that.
That's so beautiful.
Keep the beds in the living room, in the den, whatever. Keep the doors on, keep the locks on, keep the numbers in. Like, we're good.
That makes me feel so proud, the progression and the
Yes.
evolution of it.
It's sick. And right now we're doing if you follow these financing guidelines,
Yeah.
right, that Jeff or myself are sharing, you can go 20% down. And right now we're doing 20% down on DSCR loans. Interest rates, it doesn't blow your mind. Right now, 7.5%.
Wow.
You do, I mean, people are doing buy downs and stuff, and they're getting down to 7.125, which is high relative to 2 years ago, but it's low relative to where we are today.
That's right.
7.125 rate right now. I mean, I didn't even have it. I have an 8% loan.
Yeah.
You know, so I just wanted to, when I'm sharing this with investors, they're like, blows their mind that they can buy, 20% down, get these rates, or they can refi. On refinance, it's a little different. We can do 75% cash out, or we can do 80%
Rate and term.
Do we want me to go into what rate and term means?
Let's clarify. And I wanted to also touch on something here. So when we did our burst, which was, buy, rehab, refi, we had what we called at that time in our DSCR a seasoning period.
I'm so happy you hit on that because I wanted to ask that before you changed.
So we had to go through a seasoning period, which, according to the product of that time, was like you need to own the property for a minimum of 6 months, a minimum of a year before we're able to consider you to become financeable into a refi.
Yeah, I'm glad you really brought that up.
The common was 6 months. The most common one. The one that was kind of going extinct at the moment was 3 months.
We caught some 3 months and we were like, oh my God, golden ticket. Let's grab that. And then we jumped board on that one. And then they switched it back to 6 months.
So
we did not get grandfathered.
This whole year, the two lenders, we got a few lenders, 1, 2, 3, 4, probably like 4 lenders right now that we do PadSplit loans with, that we're super cool with. But the two with the best rates and the best terms, let's say, seasoning period was if you did a rehab, a month.
Wow. Solid.
If you do the rehab,
Solid.
The reason why is because we can prove with invoices and receipts and a scope of work that you forced the appreciation, right? You added value. Yes.
That's beautiful.
I
would have jumped on this.
That gives me chills, honestly.
It's so cool. And then we had this guy, we're doing a refi for him right now, and he bought the property cash for, I don't know, it feels like Atlanta. He did some work, but it's in the 200s. And he put like $30K into it, and the property value appraised for $30K more than he bought it cash for.
That's awesome.
So 2 weeks, 3 weeks later, we do a delayed purchase or just basically a refinance. And now we can use that new appraised value. It was within 3 weeks. Isn't that crazy? And he wasn't sure if he could do it. I was like,
that was a cash out or a rate and term?
This because he bought it cash.
Okay.
So
okay.
Right. So let's get into the definitions really quick. Rate and term, you're going to get a better interest rate usually than a cash out. And the reason why is because the lender who's giving you that new loan. So a refinance means you're taking the initial financing of a property. If there's financing, some people buy it cash, and you're redoing the financing. That's why it's called a refinance. So you're taking the current, if there's any financing on the property, and you're refinancing it into a different loan. So there's 2 types of refinances. There's the cash out refinance, which is where you are actually receiving cash and putting it in your own pocket. So the rule is, if depending on the lender, it's between $2,000 and $5,000 is the limit. You can't receive more than $2,000 to $5,000 back in your pocket. Okay. Or else it's called a cash out refinance.
Interesting.
So
I didn't know that.
Yeah. So these are different specific rules. So if I want to get you guys 80%, 80% rate, if I want to do a refinance at 80%, then I'm going to try to structure the loan when we go to do the refi as a rate and term, because I can get you to 80% as a rate and term, and instead of 75 as a cash out. So there's certain tricks, and nothing crazy, but just some things that as a lender or as a broker to be able to maximize the money that you get from your property within the guidelines of the lender.
And this is very technical, but in application, firsthand experience, if you are in your rehab and you're choosing to BRRRR your PadSplit property, and you have a loan for 1 year, in that 1 year you're paying higher interest rates because this is a
10,
hard
12,
money lender.
How much was your interest? Is it 9 to 12%?
Oh, fuck, I know.
Yeah,
How much was it?
It's not 9.5.
Yeah, 9.5.
And so,
I mean, and that's
which is
pretty
not bad
good.
for hard
It's actually
money.
pretty
That's not
good
bad at all.
because we had enough experiences where we were lendable,
Yeah.
and they knew who we were, so we got a good quote
That's a
unquote
good hard
rate.
money rate.
Yeah.
well, and I'll tell you, actually, even worst case scenario experience.
Yeah.
We bought a property, all our properties in 2022. July 2022, interest rates go up. You then have lenders that are pulling out of deals. Higher interest rates and values of property are going down. So values of property are going down and interest rates are going up. We try to do some refinancing. We have 1 year hard money loan. We're just finishing refinancing on a couple of our own properties. So you think to yourself like, oh, I don't need more than a year. Sometimes when you try to refinance a property in economic time like that, where rates are changing and now the programs that are available are now becoming more limited and more constrained, and there's
More limitations. Yeah.
there's way more limitations, then you might not have the opportunity to refinance or do a rate and term. So with that, then almost 2 years later, you're past initial loan. And what happens when you're past your initial loan? Your property, you
get hit with the penalty.
Now you're paying more.
Paying more, yeah.
You're almost doubling that interest rate.
Or you get hit with like a 3% fee or 5% fee just for being late or whatever, and now your cash, your ROI just drops. Your return on investment drops.
Correct.
right.
And then at some point, if you don't close, then the lender is going to want to probably try to foreclose on you because they don't want to hold that note for that long.
They want their money back.
The note being, which is the loan.
Yep.
The note is the loan.
Yep.
Right. Just terms, mortgage, note, loan, interchangeable.
So at that point, then you're not going to always, if available, you're not going to always go for a cash out refinance. At that point, that is when your rate and term ends up being your best friend because you're going to want to try to get as much of a chance to get out of that loan that you were initially in. Yeah. So you're trying to get 80% of value. So that is application of a rate and term. There are some deals based off of what the numbers are that you just can't pull any money out. You're looking to just get out of that initial loan. But just some application just for people that are watching. Yeah. Ultimately.
I'm going to go a level in advance right now. I wasn't sure if I was going to share this, but let's just do it. Let's say you got a hard money loan and you're after repair value. We are using bigger terms right now. So after repair value to your loan, to your hard money loan, let's say is 70%. So if you try to get cash out of that deal, you're going to be maxed at 75%, right? Because you only have a 70% loan of the ARV.
Correct.
Yep.
So now if, like I'm just talking like the legalities of the guidelines.
Yep.
If you got another 10% of ARV second lien on that property, right?
Yes.
Now you can do an 80% rate and term.
Huh.
Anybody picking up what I'm putting down here?
Yes.
Yep. No, yes. Yes, bro. I mean, if you want to go further,
So no, that's really it. Those are the rules.
Yeah.
How anybody operates those rules, it's up to them, right? So I'm just saying,
And
when they come to me,
I was going to say, how do you get that guidance?
I just say, when they come to me, I say, well, what's the loan on the property? They say it's 70% of ARV. Or they can say, well, I got a first lien of 70% of the ARV, and I got a second lien that's 10% of the ARV. Perfect. Now we can do an 80% rate and term.
I didn't know.
Love that.
Learned something today.
And then now I'm after the refi, like I'm paying off, the first lien and the second lien, and that's it. Now it's that's definitely
More
like
advanced,
right?
That's why you want to work with someone like Fernando.
Yeah, because the risk you have there is like if you absolutely don't have any more money, the risk is that the lender's gonna, because in a rate and term refi, you may have to bring cash to close.
Yes, it's a possibility.
It's a possibility. That means
It's a big possibility.
I confirm.
So that's the risk. That that's an advanced strategy. And if somebody tries to use that, but they work the numbers wrong, right? And then so now they have to bring thousands of dollars to close. But what if they don't have the thousands of dollars? Well, you just shot yourself in the foot. So it's like I said, advanced strategy. But hopefully that makes sense.
I love that. That makes so much sense.
You're borrowing money at that point.
Yeah, you
In
figure
case
out
you
ways.
can't close.
Yeah, and okay, let's talk about some creative closing methods when you don't have the money to close.
Okay, yes, love that.
Okay, gift funds. We can use gift funds from family.
This means my mom has X amount of money saved and she's going to contribute towards my closing, and it will be allocated as a gift fund in the closing package.
Could be your spouse, could be your mom, it could be your spouse's mom or your sister, your brother, your sibling, or whatever. Okay, here's another guideline, another rule. All right, so I'm just here to share the rules. Whatever the people do with the rules, it's up to them. So when you say that you're going to get a gift from your dad, okay, and we're saying, all right, well, there's a gift of $20,000, right? We don't actually ask your dad for his bank statement.
Right.
That was crazy.
They don't ask?
He signs a letter. It says, I'm going to gift my daughter $20,000 and I'm going to wire the money directly into closing. That's the key. He
needs to wire directly from his bank account into
He's not going to give it to you in your bank account. If he does send it to you in your bank account,
then they're going to ask.
They're going to ask him for the bank statement. If he sends the money into title directly, we never ask him for his bank statement.
Brilliant.
Okay, like I said, that's just a rule. Just sharing that. Right? Isn't that crazy?
That's brilliant.
Yeah, it's nuts because I think we had a close in, and I think my idiot self probably sent the money into the bank account. And
they're like, where this money come from? Can I see the bank accounts of the account?
But to us, it was natural transferring amongst ourselves, but it wasn't done properly.
Yeah. Right. So there's
good to know.
Those are just different, and we structure that is the benefit of you working with a loan officer that has all this experience and knows the rules and the guidelines, because you strategize on how you're going to tackle it ahead of time. Another thing that we do, when you buy an LLC, you guys.
Oh, this is a big one.
Yes.
Do you buy in an LLC? Do you buy in a personal name? Do you buy in a trust? How to tackle those financially too? Because some of these products or programs have limitations. They cannot do a refi under an LLC or.
Right. So if you're buying with a conventional loan, you can't buy in an LLC.
Right.
DSCR.
Right. DSCR you can, of course. Yeah, hard money you can, big time. So a few, just again, knowing up front how you want to close. Yeah. Somebody tells me, hey, Fernando, I want to close, but I need to use a power of attorney because, I'm going to be out of the country. Power of attorney to sign on my behalf. Can't close in an LLC. That's going to have to be closed in an individual's name. And then they're going to have to transfer it to an LLC later. Right. They just got to be cool with that. But if they're like, no, I can sign docs and I'm all good. So let's say you're a married couple and you guys have 50% ownership of the LLC. Depending on the lender that we go to, they're going to require both of you on the loan. Okay. Right. Which is a waste. You both don't need to sign a personal guarantee and you both don't need to be on the loan. So what I do is every lender has their guidelines. What percentage of ownership does one person in the partnership need to have in order to personally guarantee and be on the loan? So some lenders, it's 25%, which means we structure your operating agreement and literally it's a DocuSign. It's just a DocuSign. You just change your operating agreement where you give you, in this case, 76% and you be 24%, right? And every lender has their own specifics. Again, all that stuff gets handled early. So we already know how we need to structure the operating agreement ahead of time. So there's just one example. So that way. Also,
credit scores might work the same.
So that's a big one. Somebody has bad credit. Oh my gosh. I was working with this guy and him and his wife, he did not have good credit. She didn't have a job. And he was like, dude, I don't know how I'm going to buy this property. And I was like, dude, a DSCR loan. She doesn't need a job.
That's right. No income.
Added to your LLC. And he was like, dude, but I created this LLC as a single member LLC. My wife's not added in it. It's like, that's okay.
Yeah, we can make revisions to the LLC.
We just make revisions to the operating agreement.
That's right.
Not even at the state level or the IRS level. It's just the piece of paper. So depending on the state, it's just a piece of paper. Some states require you to file it like a statement of information in California, or there's some states, obviously there's a little bit more work, but at the end of the day, it's a solvable solution. And it blew his mind away because him and his wife maybe felt like she couldn't contribute as much to the business. And here now she's going to be freaking helping him scale because he front loaded a bunch of whatever personal credit card debt, and that decreased his credit score.
Right.
And so now that makes him not as like financeable. Verbal, exactly. So situations like that, people ask me, Fernando, I don't own any investment properties. Can I still use a DSCR loan? Yes,
you can.
And here's some of the requirements. Okay. So usually we want to see that you have a primary housing expense, which means that you make monthly payments to somewhere to live. Could be that you make $500 payments to your parents. It could make that you just pay rent regularly. You know, it could mean that you own your actual primary.
Okay.
Right? Like that's like something we usually like to see. It's possible, like if you live rent free with your parents, that's fine. We have to have your parents sign a rent free letter. But I'm just saying, like, those are all scenarios that we want to see. If you're in any of those scenarios and you don't own an investment property, I also want to see 2 credit cards that have been on your credit report for 2 years that you use.
Okay.
So it's like not that crazy, right?
And that you've made on-time payments, of course.
You've made on-time payments. And then as long as I see those things, like we can lend to you, and we can lend you 20% down, you know? So, and the money that you get doesn't have to be your money. Like we also only have some DSCR lenders that I use don't have a cash seasoning period. Cash seasoning period meaning when the money goes up in your account the day before, I don't ask you where it came from. So I don't source where the money came from.
Interesting.
So depending on when we're buying the property and how you're getting the money, I'm not going to ask you where it came from because the lender's not asking for it. So again, that's me knowing ahead of time, where's the money coming from? And then can we treat it like a gift? No, because it's coming from a private money lender.
Right.
So then I'm going to take you to another lender that's not going to ask me where the money came from. It's a DSCR loan still, right? So I just wanted to share that.
One of my favorite things of a DSCR loan, we haven't touched on it yet, is that if it does work well, does work correctly, you do pull money out.
On the refi?
Yep. It does not count as income.
Because it's debt.
Correct.
And that's with any loan. Conventional loans as well.
Correct.
Like any loan, any debt.
Not taxable.
It's not taxable.
So that money you can apply towards putting those walls up, buying that furniture.
Right.
Now, again, if you're not acquiring correctly, it becomes a little bit more difficult. I will say that dependent on a few different factors, when people ask me, hey, how do I get into PadSplit or how do I consider loans? It depends on how much money you have. It depends on your ability to acquire properties and what's your threshold as an investor. Because with those, you can factor in, okay, you have a crew, especially if you have some cash and a crew and some experience. If you're looking to the easiest solution, turnkey property, or something moderate would be how you got into it.
I had a couple other points here. So I've heard, I can't recall if this applied to us actually, but some of the DSCR does not report on your credit.
Yeah, good question. So for me, when I work with an investor, I try to ask them if they care. I say, hey, do you care if this loan reports to your personal credit or not? Because then that's going to tell me what lender to go to. Some lenders, usually the lenders that also do conventional loans and DSCR loans, they could report to personal credit.
Okay.
And the reason why is because they resell the loan. So a lender doesn't make money by holding their loan on the books. They make money by creating the loans and then reselling those loans to somebody else. And then instead of
Mac, Fannie Mae, Ginnie Mae.
Yeah, or private. Sometimes they sell to life insurance companies. I got to speak maybe a little bit.
There it goes, very white voice.
Sorry, they'll sell to life insurance companies or hedge funds, or they'll sell to like big banks like Bank of America and all these other ones. They'll sell even DSCR loans to them because they're higher interest loans and it's a percentage of their overall portfolio. So when they sell these DSCR loans, it's all about who buys them. And depending on who buys them is going to have a different reporting standard. Some of the buyers will not report to the bureaus, right? The actual mortgage. We're talking about the mortgage, not the credit pool.
Correct.
Everybody's going to get hit with the credit pool.
Right.
So unless they do a soft pull, but very, very rarely is it just a soft pull. Many times it's a hard pull. So the credit pool will show the mortgage, the monthly balance mortgage. It's possible that we do have a lot of lenders that will not report that.
Got it.
But sometimes you got to pick your battles, and right
And
now.
what is the benefit of not reporting versus reporting?
Good question. So ultimately, it's what matters is if it does report, then your debt to income ratio gets messed up for 12 months. Okay, this is my rebuttal. Anytime I need to put somebody in a DSCR loan that does report, and I'm like, look, as much as you don't want to be in this loan, this is the best product for you that does report, and here are the reasons why, right? Maybe it's an 80% cash out scenario or something, right? Like it's something particular for them that it's going to benefit them more to get this DSCR loan, but it's a possibility that it would report to their personal credit instead of getting to a different lender that does not report.
Got it.
Does that make sense? So
That makes perfect sense.
The way that I rebuttal when people are like, oh, but I'm concerned that it's going to report because it's going to mess up my debt to income ratio. What if I want to buy a house down the line? Yes. And I ask them, do you plan on buying a house in the next 12 months? No. Okay. Then you're fine, because this is a rule for any time your business covers one of your monthly debts, like your car payment or your house or a mortgage.
That's right.
If your business pays for these for 12 months straight, it gets removed from your debt to income calculation. So literally, if you have a car and your business is paying for that car after 12 months, that's going to reduce your debt to income calculation too. And you're showing that the business has been paying for it. So same thing, right? If you're buying in an LLC, and even though if the mortgage does report to your personal credit, after 12 months, you've been showing that your LLC is making the payments, then it gets wiped from your debt to income calculation.
Right.
So it could affect you,
But it's a temporary effect.
It's a temporary effect, right? And so it just depends on the strategy there and making sure, like, if not every loan officer is super transparent with that up front, and it's just asking, an investor if they care. A lot of investors don't necessarily care too much, especially after I share how after 12 months it'll get removed from the debt to income calculation anyways.
Okay. Another route that I want to take, I don't know if this is kind of in the realm, but what about creative financing? How do you tie it into it? Because it's obviously extremely popular. Everybody's buzzing about it.
Yeah.
And even of the combination of buying creative financing and make it into a PadSplit is just like, investment in steroids.
Your type of lending still factors in, because some people try to get out of their balloon or whatever, their setup, essentially speaking. So they might be good on the acquisition half of it.
Yeah.
But ultimately,
they got to get out eventually.
Correct.
So it will be a refi.
So right now, I mean, sub 2 seller finance, straight up, you don't need me. Like the seller's providing the financing, you're taking over their existing mortgage. Awesome. But if rates go down the next 2, 3, 4, 5 years, and the seller, like your balloon is due, like he's saying, like you had a 5-year agreement or even a 10-year agreement, right? But in 5 years, if the property appreciates in value and rates are lower, then that investor may make the smart decision to say, hey, now's a good time to do a cash out refi, pay off that seller, and take another chunk back to my pocket. And now, and it's a PadSplit that you've been increasing rent on, whatever, and now you're cash flowing. And so in that example, then I become part of their tool belt.
Got it.
There's another loan product though. Right now, we can go 10%. We can have the investor go 10% down, and the seller can carry 20%. When I say carry, that means that the seller is financing 20% of the purchase price.
So the bank is loaning 70%.
Yes, you got it. So I loan 70, the seller loans 20, and the investor comes in with 10% down. Right. Sorry. The downside of that one, that's going to be a high interest loan. Because if you're coming with 10% down and it's a DSCR product, and we can do pad splits. Like we can do all crazy types of stuff. We do warehouses, we do storage facilities, we do 31 units. Like you can do some really, really cool stuff. You're usually doing like very high cash flow for that type of product where the seller, I mean, I was looking at like a $1.1 million, like 7 unit in New York, or I was maybe more than 1.1. Sorry. That's, I forget. It was a 7 unit. It was way more than 1.1. Sorry about that. It's blinking on me, but overall the seller can carry even more than 20%.
Wow.
The seller can carry 40%, and I can just give a 50% loan to value side of things. So it just depends on how the buyer structures the deal with the seller. And then the seller just decides like, okay, yeah, I'll walk away with 50% or 60% today.
Interesting.
Is there a type of, so when doing a pad split loan, what's a no-go? Like, is there a cap in rooms technically or something too big?
So it just means that you're going to pay for it. You know, like I told you guys, we're the 10 bedroom, 10 bath scenario. You know, they're going to pay for it by putting 10% down more than they would have to if it did not have 10 closets. Like if that was ideally we don't really suggest 10 beds anymore. 9 beds is cool. I mean, we could do it. I'm not saying we can't do it, but we're going to be limited on financing, and you may be in a position where you're going to have to accept whatever terms we can get you. Yep. You're not. I mean, if you think you're going to make money, then awesome. You just may not have the best terms. But as of right now, we can still do them. And it just depends on when whoever reaches out, and we look at what loan products we have available, what the rates are, and what your down payment's going to be in that setup. As of right now, somebody has 10 closets, we have to go 30% down, and you're probably going to be at an 8 to 8.5% rate.
Which is still not even that bad.
It's not terrible.
It's high, but it's still not bad.
Yeah.
For something producing money, I mean, if you're making $900 per room.
Yeah. Then if the numbers make sense, I mean, people still do it. For sure. And they'll say, nope, let's do it.
I mean, I've seen, what type of housing was that in South Tampa? That was a true, not halfway house.
It was a boarding home.
Like 20 something rooms.
It was a 20 plus.
And it was a single family home or no?
No, it was commercial. It had sprinkler systems at that point.
It was commercial, but it was set for boarding home.
Okay.
So they were providing hot meals. Anybody was allowed.
If they're doing full rehab on it, I'm sure they're going to want to get out of whatever loan it is. They're not going cash.
So that's the one where I would probably do the a 70% loan to value, where we could probably do it on that deal.
Makes sense.
But they're going to be paying
30,
10%. Right. I mean, right now it'll be like in the 10s.
But you're the only option at that point.
Possibly. Yeah. There's other, and the nice part about this one is it is a 30-year fixed rate loan. So other commercial products will be like a 5-year loan, but then you have to sell or refi in 5 years. And then depending on the investor, some people don't like that because you don't know the position you're going to be in, where in 5 years, like your rate's going to shoot up because they're on an arm or something, like a variable type of rate, or there's a balloon on that commercial deal. So I don't know if you guys heard about a lot of the office buildings were on these type of products.
No.
Yeah, a lot of the commercial buildings are on these types of products where it actually sometimes they'll start you at a very low rate. Like we can get a commercial building for like 5, 6%, which is really good. But in 5 years, that can be variable. And they may want to call it, like they may say it's a balloon. There's a balloon in 5 years too. So then a lot of the office buildings right now are kind of in a tough spot.
In a pickle. Yeah.
In a pickle.
Sorry.
Go for it.
I was going to say, have you done something, or are you guys working on something where if I have untapped value in my house, I've had a pad split for 5 years, that I'm able to pull some of that out?
Like there's some equity built.
Or
like a HELOC.
Like a investment HELOC?
Yeah, like a HELOC.
Correct. Or tap into that equity by...
Not a refi.
No, like a cash out.
No,
like an equity line or a HELOC.
Yeah, kind of like an equity line of credit against a pad split type of property.
So the way I currently solve that, because I'm doing that right now on my own deals. Yeah. But it's not going through me. You're just basically structuring your private money second lien. So you go up to a private money lender, which is literally a friend, family, cousin, whatever, and you say, hey, I need $60,000 for a certain amount of time, right? And 9%, 10% interest, you drum up the contract and you have a private money lender. And then for me, what I really like about that is I usually don't pay points, you know, because
origination
fees. I don't pay underwriting fees. I don't pay processing fees.
Crazy fees.
I don't pay title fees. Like there's all these fees I don't have to pay, which don't get me wrong. Like that's how I make a lot, like we all make our living, you know, lender, whatever, me, title.
Processors.
But if you don't need to, if you don't need me, I'm not going to tell you to use me. So I'm giving the solution that does not include me. And it's a solution that I use.
No,
which
it's
is
wonderful.
I just collateralize my current investment properties that have equity. And I go to somebody and say, look, and I just make the deal so good. I'm only asking you for $60,000. And look how much cash flow my property's done in the last 12 months. If I don't pay you back, you get 50% of my property and 50% of this cash flow forever. Deal? They're like, yeah.
Yes.
You know what I mean? So that's what I'd recommend.
I like that.
I like that. And that was very nice of you because, I mean, you're not, it's just free tips.
Yeah.
Before we kind of wrap up, what are the most important questions that a person that is working towards buying a loan should ask a lender?
Oh, to get a loan? So,
yes. Like you're trying to get a loan. What should I ask my lender if I'm not sure?
Yeah. So
even though we covered so much right now.
So are we trying to buy a
PadSplit? Yes,
PadSplit,
this is all PadSplit.
So, you know, so me as the lender, because I'm also an investor, I actually ask the questions. And I'm like, well, why do you want to buy a PadSplit?
So you're qualifying your buyers.
Because the other day, like somebody came to me and said, hey, I want to turn this into a PadSplit. Like, help me buy this property. Yeah, this was just literally yesterday. And it's a 3-bedroom, 1-bath. And
you're like, why?
Exactly. I was like, she's like, oh my gosh, I'm getting it for like 80%. It's worth 300. I can get it for 240. And I was like, sweet. But that's not a PadSplit. That's a wholesale deal.
Right.
You can get it under market value. Go find, like I said, lock it up, do a 90-day contract, go lock it up, and then go find an end buyer that's just going to like to live by the lake. But it's not a PadSplit, and you don't need me. I'm not going to help you get a loan for that if you don't even want to keep the property. You know what I mean?
Yep.
So that's literally how I start my conversations, because first I need to figure out if there's even a loan to be had. And if your deal's not a good PadSplit, like I'm going to tell you, because it'd be a disservice to give you a loan. So that's number one is, are they asking enough questions? Like, do you feel like if you go into a doctor's office and the doctor's like, oh, looked at you, I already know, here you go, this is what you need. You're going to be like, dude, you didn't even ask me any questions. So number one is, do you feel like they are helping you feel qualified for whatever decision you're making? Yeah. And that's probably honestly the most important one. And then in terms of what questions you're supposed to ask, what questions should I be asking you is a good one. If somebody came into me and said like, hey, what questions should I be asking you? And then I start asking, and then I start saying the questions. And so one of the questions is to say like, who do I talk to when I make a decision? That's a big one. Like, because sometimes they don't know how to make a decision. If I give them the answer, if I give them the loan, like the terms, right? They're like, hey, I want to buy this property, and I'm the first person they talk to, right? Then I can only give them the loan terms, but I can't tell them it's a good deal because I'm not the investor for them. Yep. So I say, are you talking to an account executive? They're like, what's that? And I'm like, whoa.
Let me set you up.
Let me hook you. Have you heard of this podcast? The Co-Living PadSplit podcast. So that's number one. I say, and then now I can add value.
Right.
And I can say, cool. All right. Go talk to Oriana. She'll hook you up. O hablas español. Todo bien. So.
Gang.
So and just making sure they have the right connections.
Yeah.
Property management. Yes. If I know they're buying in a certain area.
Out of state.
And I have a property management, right? And I'm like, hey, do you need me to make an introduction to a property manager? Cool, I will. Do you have an agent? Do you need me to make an introduction to an agent? And so things like that. Because then I tell them how to make the decision. How I make the decision when I was buying was like, I need to check my data points. I'm talking to my rep to make sure my numbers are accurate. I'm talking to my agent to make sure like we're getting acquisition deals, or if I'm talking to wholesalers, I'm talking to my lender. So I know what my purchase terms and down payment and closing costs are going to be. I know what my terms are going to be on the refi. So you really just have to know how to build a team. But I always tell the investors, like, you're the decision maker. Nobody else has to live with the loss or the gains, but you. And so at the end of the day, like, I want to make sure that they feel some weight on their shoulders, that it's not, we're not making those decisions for them.
We're facilitating
we're facilitating the tools.
Yeah.
But at the end of the day, like, I don't want to carry the weight. Like, the weight's on you. So that they have to be ready to make some hard decisions. And sometimes investors they're not ready, like, mentally. And sometimes, because it is a lot of, it can be a lot. It feels heavy to have to pull the trigger, make some decisions.
It's a big risk for sure.
I'm curious if there's someone that's looking for, if they come to you, they have a sweet deal and they need some guidance. Would you consider JVing with someone or jumping in and doing something
as an investor?
Yeah.
At this point in my business, man, it's tough, dude. So I JV with others. I raise capital, right? And it's one, let's say, like, the biggest thing is like morals and ethics. If it's a random person because I have access to the numbers and the books for my partners, and I got like a refund check from the insurance company. It was like $3,000, and it was my name. And I was like, you could have just, if I put this in my own checking account, my partner's never going to know because they're just trusting me. Yep. There's so many ethical decisions that I have to make. And it's just, I don't know. It just means a lot of trust into that other person, or whoever's going into it. So it's not like just off the bat, I'm going to JV with you. You know, there has to be significant trust for me to say, like, I don't think you're going to, stab me in the back or hide stuff. So that's a tough one. So as of right now, no.
You're not set up for that.
Not set up for that. I'm not. Yeah.
I respect it.
Focused on other aspects right now.
I respect it.
But as advice to everybody else, there's QuickBooks, right? And you're tackling transactions, but like a check, you don't necessarily know some of that. Like, the check is like outside of your bank connection.
Yep.
Correct.
So, that's something like that really is just trust. You just have to have a lot of trust. Going back to, we check our property managers' ledgers, right? And we check PadSplit's payout to our property managers. And then we look at the income that goes to the property managers and check the ledgers, and then it goes to us. So, like, we're tracking all of that so that when I meet with my investors once a month, I'm clearly outlining, like, all the expenses. And if there's ever a big expense that I've categorized, I make sure I have the property manager ledger ready so that when they ask me questions like, hey, why was maintenance expense $1,000 instead of $300? Here's the ledger. This is why. Stuff like that.
That speaks loudly also about you.
I respect it. And the reason why I say I respect it is because when you are partnering with someone, it is like a relationship. It is very much like a marriage.
It's a marriage.
And with that being said, you're very choosy on who you marry. You just don't marry anybody. And so it was just to see if there's someone that's out there that wanted to potentially JV, it makes sense. I wouldn't just JV with anyone neither. So
right, yeah.
Wow.
I do have actually another question. Or sorry, the big one is when you are talking to a loan officer. Yeah. Sometimes I feel like you have to qualify them.
I agree.
And
it's like equally when you're using a realtor that's representing you, you need to kind of qualify them to know that they're fit for the job that you're paying them to do.
Totally. And you could be not, like, you could be wasting your time for a little bit, or worse, they spin you in circles, and a lot of my deals come from failed transactions, which I'm okay with.
Yeah.
But how do you prevent that? The first one is, how many PadSplit deals have you closed? Why are you so sure that this is going to close? That's a big one.
As a wholesaler or as a realtor?
No, someone coming to him with a deal.
Okay, an investor.
An investor.
Okay.
Because we're like, what should they ask other lenders?
True.
Right. And it's just like, hey, like, how many of the PadSplits have you closed? They're like, I haven't closed any of the PadSplits. Like, well, I mean, if you're a beginner investor, should you be working with another beginner loan officer in that space, right? It's a tough, it's part of the risk.
Right.
And those are some of the deals that like Jeff and I have saved for sure. So that's a simple one. If you're an experienced investor, then you go to any loan officer and you ask them that question too. At least as an experienced investor, you can ask deeper questions like, well, how are you going to handle it if an appraiser goes into that property and sees 7 or 8 rooms with doors with PIN codes and
Door numbers?
Like how would they handle that, and how would your lending team and underwriting handle that? And if they're like, I don't know,
We'll find out.
like we'll find out. Like, let's do it. So you're just, luckily we can do appraisal transfers. So a lot of the times, if an investor goes to do something on the property, if the appraiser did a decent job, or if I can somehow communicate through to the appraiser for some modifications that we need, we can do an appraisal transfer.
Yeah.
So it's not like they don't have to totally get a brand new appraisal.
That's awesome.
We can do appraisal
Does
transfers.
that appraisal have expiration date of sorts?
Usually it's like 90 days
Okay.
to 120 days.
Okay.
That's usually depending on the lender what they'll accept.
Cool.
And some lenders we're like, no, we need to do our own appraisal, no matter what.
Got it. That's really solid. Great questions.
I think it's absolutely key to vet the person you're working with. So ask throughout, like you said, realtor, loan officer. And I feel very comfortable sending people in both your directions because you can say, yeah, they are successful in owning PadSplits, understand PadSplits, and can speak on it. And you don't have to educate them because they'll probably educate you.
Yeah.
And it's not that
Good
you're
one.
their reps neither. They still need to talk to an account executive, but
Right.
at the very end of the day, this is not foreign to you and
Right.
it's not taught to you.
And you're good.
Yeah, no, I also wanted to add, this is why PadSplit only recommends certain people on their network vendor. They will
They're
not
approved vendor.
recommend or suggest anybody that does not have any prior experience in their specific field tied to PadSplit.
Right.
So I get calls from realtors all the time. Hey, I want to get on the PadSplit program. How do I do it? I'm on leads. And I'm like, you got to prove yourself first
Yeah.
before that's even a conversation.
That's
So
good.
how do I do that? I'm like, go find investors that want to buy PadSplit, sell them, and then we'll talk.
Yeah. That's so good.
Versus like the concept of I'll just go to Zillow, buy some Zillow leads. And no, that's not how it works here.
Yeah.
You got to
It's-
prove yourself first.
So in Orlando right now, how's that market going right now? With is it mainly wholesalers or agents? Like, what are you guys seeing are the type of investors coming into Orlando, and where do you see the opportunity in Orlando?
I've seen early on a lot of conversion.
Okay.
Holders, existing holders.
So, existing holders,
Yes.
converting to a PadSplit.
Mhm.
And they'll do that with some of their properties, but then I've seen them then start to buy properties. So instead of flipping properties, they decide to burr the property and keep it. And so they got very good at,
Acquiring through
Yeah.
wholesale or off market.
and then
Another big one, another big acquisition here is creative financing.
Oh, in Orlando,
Mm.
nice.
I would
Nice.
say all of Florida.
And so then they only have to worry about the rehab. They can buy creatively, and then they can just put the 30 grand or whatever
Yeah.
to convert it. That's super good.
so, I mean, that's
Yeah.
the combination of things. But Florida as a market, we've grown out in a lot of in-between places. So when you look at Atlanta definitely spread. They spread a lot. But when you look at the map of Atlanta, it just says Atlanta. And Augusta's not really filled in. Savannah's not filled in. It's
Yeah.
neither of those.
Macon, or
Mhm.
those
Yep.
ones are right
Mhm.
like
Mhm.
45 minutes to 2 hours away from Atlanta.
Mhm.
It'll be spotty. You might find maybe one or something. But in Florida, it's Jacksonville's huge. Tampa's huge. And everything in between on I-4 is filling in. And Orlando's growing in.
Mm.
Miami, we're down there as well. But then you're starting to see most of the East Coast and most of the West Coast. So all of it is fitting in. It's just that now people are trying to figure out where to buy, and they're looking at secondary markets, kind of like the Beach, Cocoa, Melbourne,
Mhm.
where the purchase prices are cheaper.
What's cheaper?
Cost wise,
No, we're talking about 200s.
200s?
Because Orlando and Tampa, you're not finding anything under the 340 mark.
Okay.
Jacksonville.
That's fixed up. That's a fixed up house.
No, it could be a fixer upper.
Mm.
a normal house that needs some type of rehab.
It could be like a paint and just flooring, but still need some updating.
Okay.
Jacksonville under 150 you can get, but and even at 100, I wouldn't necessarily recommend the ones under.
The areas
100.
are going to be a little bit more challenging to work with.
Our cheapest acquisition was an $82,000 purchase.
In Jacksonville?
Yep.
Yeah.
Sick.
Yep.
A
And how much
priest for
work-
like
how much work-
186.
How much work did you guys put into it before PadSplit conversion? Let's say.
30.
Oh, that's not bad at all. And then you PadSplit converted another 30 or 40.
Like another, well, a lot of it was pre-plumbed. A lot of it was pre-set up. So it was very minimal on the tail end. It was the furniture mostly. It was a 6-bedroom. So I'd say maybe another 20,
That's
25.
2025.
And then we were able to pull out $30,000-$40,000 at that property.
Dang.
And I would say that's maybe our perfect burr that we could like hang our hats and say,
Truly.
we got one out of
You
our
did
7.
You did a perfect bird.
That's the perfect burr. But what we're finding is difficulty in finding inventory.
Yeah.
Like honestly, it is as PadSplit just chasing in different directions.
Sure.
Now we have lenders, but to continue to find good deals, 70 cents on the dollar, 75 cents on the dollar,
Yeah.
it's difficult. And if you're buying off the MLS, is difficult. And still with the agents that are involved, some of them want you to just do highest and best. They don't really negotiate to get that cheap enough price. And it might not even exist so often. So
What do you think about wholesalers just being able to, and I know this is a lot more work, but like I don't have time to acquire, like search for properties every day. I mean, even you guys don't have the time anymore,
really.
like search for properties every day, but wholesalers are literally searching for properties every single day.
Mm-hmm.
So how do we get wholesalers to look for, for a PadSplit, like to, type of property, to already see the vision, if at all?
I think that we're already training some of the wholesalers that are in our circle to do that.
Cool.
It helps their business first and foremost.
Right.
They are able to acquire more. Now more deals make sense,
Yeah, that's sick.
right?
That's true.
So underwriting now deals that might have not been good for flipping or buying hold or even short term. Now it's like, oh, there's some skin in the game on this one. This is a good acquisition.
Yeah,
So
'cause
it-
even if you leave some money in the deal, if it's less than the 20% plus closing costs and the rehab, put together,
Mm-hmm.
you're still winning.
Right. So we are training some of those wholesalers that are seeing what PadSplit is creating and what we're already accomplishing. But it takes a visionary.
Yep.
Not a lot of these wholesalers are also doing long-term game
Right.
businesses. They're transactional. So we're really focusing with those operations that have been doing it for a while, that have gone through 2020, 2022,
Yeah.
2024, and they're still doing it, and they're finding ways to create those deals. They're finding the right acquisition prices, and those are the people that we personally are focusing on teaching them, educating them, and allowing them to see what we're building for both of our, benefit.
Yeah. Cool.
But some wholesalers, and again, they're just 2 acquisitions a year.
No, I'm excited for you guys to continue to teach more wholesalers just across the United States. That's going to help all of us.
It really makes sense.
I mean, a little ask. So when you go back into your market and you start to do meetings again and you start to educate people and grow out, obviously, the people in your sphere of influence, educate those wholesalers for us so that you can obviously get them to now do more deals and help themselves, but so that we can educate these investors on other ways to buy properties so that now you can also get more transactions. And now we're being a part of this ecosystem where it's becoming smoother and education is flowing a lot more. So I look forward to obviously I got questions because we know what motivates you. We know all of this. What are some of your upcoming goals?
What has you excited?
So launching a conference is actually I want to host a conference. That's like
Okay.
That's
What are we
seriously
what's it gonna be about?
co-living,
Okay.
and it's PadSplit's. I mean, co-living is co-living.
Yeah.
right? PadSplit's a co-living strategy.
They're a player in the co-living world.
But there's like entrepreneurial co-living, professional co-living. So there are different pieces of co-living. And I think at the end of the day, it's like, whose problem do you want to solve? Student co-living? I live in a house with 15 students. That was co-living. Right. And so I believe in co-living in general. And some people, they want to self-manage, like, cool. But you're not gonna be able to, it's gonna be difficult to scale to significant volume. I mean, PadSplit as a platform of just tracking tickets and member communication and rating systems, and like, there's so much value that PadSplit as a platform provides, and it's more of a long-term model. We used to think PadSplit was a short-term model. It's not a short-term model. It's a long-term model. Like that 6 to 8 month rule, even that I don't really listen to anymore. It's like, we've had one person in my house for 4 years now.
That's incredible.
So it's a long-term model.
I agree.
That's so to answer your question, a co-living conference where I can bring in, maybe Atticus. I think that'd be really cool. But I already, thinking of other co-living mastermind.
I'm gonna add Josh in there.
Yeah, Josh too. That's true. We can.
The co-living couple will happily do an episode at your event.
Co-living couple, that'd be sweet. I think it would be super fun. I think we're ready for it.
We need it.
Truly do.
We are already looking into. There's the buzz of PadSplit Con.
Oh, that's tight.
So yeah, they floated the idea out
So
potentially, but
I can't wait to see your conference, and I'm going to be a part of it.
Yeah. Thank you guys. Thanks for having me on.
Thanks for being on, brother. Awesome. You're inspiring. You really are a fantastic person. And we look forward to obviously your growth, not just in business, but personally and in our friendship. So we really greatly appreciate you being on our couch.
Wait, hold on. How do people get a hold of you?
100%. Damn it. Before we leave, how do we contact you?
If somebody's trying to get Fernando closing those loans for them, how do we get a hold of you?
Or follow you or donate money. I don't know.
I know. Donate. Right now, 626-714-2440. It's like straight up. That's my number. Text me. I'm going to be super responsive with text and
text is best.
And phone call and everything. If I don't get back to you, there's a loan officer on my team, and we're looking to,
grow the
build
business.
our loan officer team too. But somebody, we've built our business on like a good reputation, and part of that good reputation is like communication. So even if I can't get to somebody yesterday or today, I'm like, hey, can we schedule time for Monday or Tuesday? Just try to be responsive at the end of the day. So cell phone was perfect for text because I'm really communicative on my text, and then email. Don't email me right now. If you're watching this, just seriously, just like text Instagram. If we can share Instagram too.
Yeah, we'll share it on the description.
Cool.
For sure.
At ITS Fernando Corona. So it's Fernando Corona. Then I'd love to connect with you guys. Message me on there too. Don't Facebook message me yet. Does Facebook, have you ever messenger, like it goes into like this message request?
I don't even know how to, I miss all the messages.
Unless you look for it, then that person's lost for a couple months.
I see it.
And I feel so bad.
I see it months later. I'm like, terrible. I feel like ugly.
Instagram does that too, though.
Instagram does too, a little bit. You're right.
There is like how do you want to read
hidden.
those?
But the thing with Facebook on your phone, you need to go through a different app. At least on Instagram,
the Messenger?
Yes.
Right.
Like
so
it's
just text the phone.
And DM.
Then, and in the DMs
you
too.
You have a website?
I do have a website, myremotelender.com.
Okay.
So actually the name of the brokerage is Remote Lender.
Okay.
Love it.
Yeah. And so.
And you're obviously operating in all 18 cities that PadSplit is currently in.
Yes. Currently, the only one I don't operate in is Las Vegas, Nevada. Nevada has really strict rules.
It's always a tricky one. Yeah, it's always a tricky one.
That's the only one I don't operate in. Everywhere else, yes.
Wonderful.
Yep. Probably like right now we're like 40 different states.
Awesome.
So
beautiful.
Going well.
Fernando, thank you. And he's also looking for a loan officer that speaks Spanish.
Yes, I am looking for a loan officer who speaks Spanish on my team. And I mean, I speak Spanish, yo hablo español, but we need somebody that can handle like big Spanish community to speak Spanish. Or honestly, even speaking another language.
Yeah.
We think there's a big community
type of bilingual.
For PadSplit. Like we're talking Portuguese too. Maybe Cubano.
That's a whole separate.
Cubano is its own separate, dialect or something. Yeah.
Thank you guys for tuning in. Fernando, thank you again for being here and for granting us all of you in this time.
Thank you so much.
Peace. Thanks for tuning into the Co-Living with PadSplit podcast hosted by Ray and Orianna Nunez. For more exclusive content and community updates, join our Facebook group and follow us on all social media platforms. Stay tuned for more episodes.